the downgrades, potential continued volatility. And I do think that combo will create more opportunity, not only in terms of the deal flow that would potentially come to the non-bank lending universe, but also this ability to have continued tighter selectivity, right, and better lender protections, and have a more lender-friendly environment, which is ideal. Those platforms that have scale and flexibility and then the capital in that non-bank universe will continue to take the share.
Welcome to the Tao of Chao podcast, where we will try to find balance and provide a clearer path forward in this uncertain world. Alona Gornick serves as the Managing Director, Senior Investment Strategist, and co-head of the Chicago office for Churchill Asset Management, a subsidiary of Nuveen. In her role, Alona provides meaningful investment insights across the private capital spectrum to the investment community. She works closely with Nuveen's global distribution team to deepen relationships with and educate Churchill's investors and partners. Alona joined Churchill in 2017 as an originator, developing relationships with leading private equity sponsors to source and structure high-quality deal flows for the platform. Prior to joining Churchill, Alona spent 14 years in various investment capital markets and investor relations roles at leading organizations including Nuveen, Golden Gate Capital, and Oaktree Capital Management. She began her career in investment banking in the gaming and leisure group at Bank of America Securities. Alona earned her Bachelor's of Art in Business Administration from the Kenan Flagler Business School at the University of North Carolina at Chapel Hill, and her MBA from the Wharton School at the University of Pennsylvania. And here is Alona Gornick. Alona, welcome to Tao of Chao, and thank you for being with me today.
Absolutely.
I'd just like to learn from you about this, ever-expanding world of private credit, because you are the expert in it. And it seems that more and more asset managers are getting into this space. I mean, so many people have approached me over the last, I want to say 10 years. This is certainly true since the great financial crisis of GFC. So before we get into our discussion about the nuts and bolts and risk and rewards of investing in this space, let's chat a little bit about how this market came about. I think that will be really helpful. And perhaps you can start with the fallout of GFC and the imposition of the Dodd-Frank Act and also the Volcker Rule. I mean, I can't say Dodd-Frank without talking about Volcker Rule. Alona, help me better understand how post-GFC and a new and more restrictive regulatory environment gave rise to, and I know you are not a big fan of this, but I'm going to use it anyway, shadow banking system, not derogatorily, it's just not the real true banking system, and how private credit is one of its expressions. Do you want to share a little bit about that, and so we can get the framework?
Sure, happy to. And thank you so much for having me on this podcast. You approached me about it, and I felt so flattered. And to be, in your words, a private credit expert, I will do my very best and just share perspectives from what I've seen so far. But as far as the shadow banking term that you use, yes, it's one that I want to spend a little time clarifying, because I do feel like it can tend to be used in different ways and sometimes just have a sort of negative connotation to it. But just broadly speaking, if we start there, the term has come to refer to a broader base of the non-bank financial companies, right? And by their nature, operate with less oversight from regulators than traditional banking institutions. But that said, there is still a very great deal of rigorous credit underwriting, portfolio analysis, risk management across the non-bank lending universe that, is really important to these platforms, particularly given the rise of really large non-bank lending platforms that are actually supported by massive asset management businesses, global financial institutions, really big insurance companies that they themselves are regulated. So certainly, while non-bank platforms have less oversight from a traditional sense, I just wanted to say it doesn't necessarily mean less oversight overall, right? And arguably, as we'll get into later, potentially as the supporters of private credit, non-bank lenders could be seen as potentially more appropriate long-term capital sources versus banks that have more of that customer deposit sort of capital base. And that non-bank platforms have diverse capital sources, so better able to withstand cycles. But let's go to your original question about sort of how did this whole thing get started, right?
Right.
So as the rise of non-bank lending, when we go back to sort of that GFC era that you were talking about earlier, I'd say you're absolutely right. The growth of private credit was really born out of all of that legislation that you talked about that was really passed in response to the great financial crisis in 07 and 08. And then the 2010 Wall Street Reform and Consumer Protection Act, both together known as the Dodd-Frank. And then afterwards, I think you mentioned this as well, this edition of the Volcker Rule.
Right.
And if you even fast forward 5 years, in 2013, we got the OCC, the Office Controller of Currency, to come in with leverage lending guidance, as you mentioned earlier, just sort of curtailing the amount of leverage that institutions could put out. So it made it essentially really punitive for traditional banks to extend credit, right? So traditional banks overall found themselves in a situation where there was much closer, regulatory scrutiny, and essentially, created this sort of retrenchment of capital, if you will. And that capital being available to borrowers, particularly those considered smaller than the large corporate, and what's now known as, more broadly, the middle market. And to many investors' surprise, this middle market segment has actually shown some pretty impressive resilience and growth. So while you saw this capital retrenchment happening from traditional lending sources, at the same time, you'll remember that the Fed embarked on a massive stimulus campaign to really get the economy back on its feet. And I think in less than a year, we saw the Fed raise, cut rates by almost 300 basis points from 4.75 to 2, and then got us to 0 by the end of 2008 and sort of stayed in that very low range for quite some time. So you've got this combination of capital retrenchment and then very low rates. I'd say what happened at the same time there, asset managers, insurance companies, institutional investors were all in this search for yield, right? And it fueled this growth into private credit investments, right? And that gave rise to this new class of non-bank lending platforms, which really were really in place to support, post-GFC, strong, healthy businesses that just tend to operate in this middle market that still had growth capital needs. So effectively, I'd say it was regulation, tighter regulation, and then that combo of a search for yield that helped fuel the growth of non-bank lending platforms.
You're giving me a lot, so I keep thinking all these more questions, so I'm going to try to remember all the questions I have in my mind. But before we do that, perhaps we should chat a little bit about, we can divide the banking industry into sort of 3 segments. There's the super big banks, the top 10 or 20 banks. Then there's all these middle-sized banks, and there's the little banks. The little banks are really more consumer banks and all that type of stuff. And the very big banks are doing those big things, and they're the too big to fail banks. And there's all these, what they call middle-sized banks, which is apparently, tell me if I'm right or wrong, it falls between about $10 billion to $100 billion in assets. And traditionally have been the main lenders to mid-sized businesses. In March this year, as we know, that we saw the collapse of 3 mid-sized banks and calling into question the reserve adequacy of these institutions. The banks failed to, basically, I don't know how, but they failed to anticipate, even little old me know that interest rates are going up, and to manage their shrinking reserves because interest rate went up, so their assets went down in price. Even though it's well broadcast, they seem to have not able to manage it well. Some blame this occurrence on just watered down regulation since GFC, because there have been some watering down. And some just basically say you didn't do a good job. But since March, interest rates have risen even more with the new proposed regulation for stricter bank capital requirement. So they're double whammy, less money in the bank to lend and tougher regulation to keep more in, reserves. So this may mean that more bankers still may get into trouble with less room for commercial lending to mid-sized businesses, which you said is very robust, and there's a lot of very good businesses who need lending. Is this true? And if so, is the middle market lenders, which you mentioned, will play an even more expansive role in the marketplace to come?
I'd say the collapse of those three banks you mentioned in March. It's SVB, it was Signature Bank, and First
Yes.
Republic, right?
Yes.
That was definitely unsettling. It was a shock to the system. I'd say even added to that, more recently, end of summer in August, we saw Moody's downgrade
Yes.
10 more banks, right? And I think they put 6 under review, and they maybe had a negative switch on their outlook for another 10 or 11 banks. So certainly a much more scrutiny on the part of credit rating agencies on this exact segment of lending institutions, that middle, the small piece of the lending universe. Do I think this means potentially more trouble? Maybe, for those banks. But what I'm more inclined to see is that you'll likely see these traditional, smaller regional banks enact what I had said earlier about what we saw in 08 and 09, that tighter, restriction on lending, maybe more scrutiny on who they lend to, if they lend at all. They might pull back altogether on lending to this mid-sized business that they had historically been supporting. Whether they do it in the form of lower leverage or less financing altogether, or just completely pull out because they may have some troubled assets in their portfolio, I think it would lead to some certainly dislocation or disruption there. But at the same time, what I'd say is that type of, the downgrades, potential continued volatility in, the broader banking sector, that, those that trade publicly, I do think that combo will create more opportunity for the non-bank lending platforms we talked about earlier, not only in terms of the deal flow that would potentially come to the non-bank lending universe, but also this ability to have continued tighter selectivity, right, and better lender protections, and have a more lender-friendly environment, which is ideal for non-bank lenders. So not only are you going to see potentially more pickup in deal flow, but you'll see higher quality borrowers. Any transaction that we'll do today, we're going to do it on non-bank lenders' terms, right? We're not going to negotiate those terms away. If not, we just won't do the deal, right? So I do think those platforms that have scale and flexibility, and then the capital in that non-bank universe, will continue to take the share from the commercial and regional banks that have now been in a place that they're going to have to step away.
So basically, as bank recede from where the traditional lending practices, for all the reasons you mentioned, the private side, or we don't call it shadow, but private lenders are picking up that gap, right?
Yes.
And that has been a phenomenon since GFC, and it continued to expand as banks continue to, from time to time, run into trouble. One of the things you mentioned was fascinating, is that as the Fed drops this yield to zero, as you have stated, that people still need to make an income or what have you. So people are looking for more yield. And so they turn to private market for potential opportunities. There are 2 questions here. One is really talk a little bit about how mid-market borrowers, the process of going to a bank. Let's say I want to borrow, I'm just going to use a number, $100 million to redo my plans or what have you, whatever business I'm in. And I go to a mid-sized bank. How that bank may not be able to cut a check for the entire amount, but really need to look at others. Can you talk a little bit about that process? Because that's one of the inefficiencies, I think, in the banking arena that actually gave a better opportunity, easier access through private markets. Can you talk a little bit about how that works?
Yeah, I'd say what you're pointing out are the sort of limitations, if you will, around what a traditional bank had historically, and now even more in today's environment where there are tighter controls and more focus on risk and risk taking, as to how much they would lend to any particular borrower. And nowadays, that borrower has options, right? They have the option to go to their bank that may provide many services outside of just lending, treasury management, FX, certainly if they're global, and otherwise equipment financing, they can get them from a traditional bank. But for the lending component of what they need to either fund an acquisition of another company or the growth of some plants or construction loans, there's certainly other options now. In the private credit universe, where you have non-bank lending platforms, funds or otherwise, supported by very big and diverse sources of capital, there is more flexibility. There is potentially more flexibility to see a larger loan, maybe more than that 100, or that loan of 100 with different types of features in the credit agreement that give flexibility to that borrower as it grows. So certainly as you make certain milestones, we will extend more credit, or we will give you more cushion in covenants that we would put into the credit facility to make sure that you're growing the right way, but you might get more flexibility out of a non-bank lender than you would maybe a traditional lender. So I do think that the optionality for borrowers makes that very interesting. In addition to the fact that a non-bank lender and in a private credit transaction, you don't have to go public with this deal. You don't have to syndicate that $100 million to a bunch of other potential buyers. That non-bank lender, now in this world, very scaled, could actually take down the entirety of that $100 million. If you got a commitment from one lender that says, I can do that whole thing, or if you got a proposal from a bank that says, I can arrange it for you, but I would syndicate the majority of this to a bunch of other small buyers. We'd have to put a big presentation together. We would have to get you rated. We'd have to go this whole process, and we'd have to make it a public offering to make sure that everyone knew about it. That increases the risk of execution, of the timeliness of it. And, frankly, even to please all those minds to make it a saleable transaction, you might have to give up all of that flexibility that you were seeking with going with one lender that could possibly give you all of that. So I think that optionality is very appealing as far as when you choose between the two paths. So in terms of what you can get out of that non-bank large-scale platform nowadays, it certainly is an attractive option for borrowers that can, in this environment, show operating resilience, recession resilience, the ability to pass through price increases in an ever-increasing inflationary environment. We're not just seeing private credit managers give loans to just any type of borrower, right? We're seeing that very high-quality borrower come through. And also, we're going to put the right amount of leverage on that business. We do not want to overburden that business. But I think it's important maybe to even sort of step back and talk about private credit as to just explain it, right, for our audience. That we're using the term quite easily here. But private credit as a whole, and sometimes it's also referred to as private debt, very similar. It's, as we've been talking about, it's essentially non-bank lending or an alternative source of lending that generally refers to like a larger class, if you will, of higher yielding, illiquid investment opportunities or loans that are essentially privately negotiated. And they're also directly originated or typically originated with the borrower. So between a borrower and a lender or a group of lenders. And these transactions, once completed, are not traded in the public market. So within private credit, that broader asset class, I'd say there's many different subsegments inside of private credit that don't, necessarily fit neatly within simple categories of, of private credit. So you've got a very diverse range of risk return profiles, even within private credit. Got direct lending, that's the largest subsegment, which is most of where my comments are coming from. You've got distressed debt, mezzanine finance, special situations, venture debt, equipment, financing, asset-based lending. These are all within private credit. So when we talk about numbers of private credit and how big it is enormous. And when you talk about how many, new managers are coming into this asset class, it may sound and feel crowded because it's just another credit manager coming in every day, maybe
Right.
5 a day that you're hearing from. But there are so many different categories within private credit. It is now on the onus is on the investor or the advisor to take a better look at what strategy are you pursuing in private credit? What's your experience in that strategy? Or did you just come upon it because you thought it was, a way to pick up yield? Because certainly in today's environment, private credit is seeing incredible yield when you compare it to fixed income, when you compare it to high yield, with far less loss rates, far lower default rates. So it's a really compelling opportunity in private credit overall.
So thank you for that. That's where I really wanted to go, is about this whole ecosystem, right? Where did all this debt, borrowers coming from? Where is all this money coming from? How did we matchmaking? So is it fair to say that private credit is really non-bank lending? That's basic what it is. And we're lending, we're just not a bank. that allows us more flexibility to be more personalized to the borrower, more sensitive to their needs, and perhaps looking at a longer duration in terms of how we can help them to achieve their business objective through borrowing. I think I'm sort of
Absolutely.
reflecting what you said.
Yeah.
Right.
Yeah.
And it's also fair that not all banks are created equal, and thus not all private debt managers are created equal. And I don't mean better or worse, but they may specialize in different segment of the market, from very high credit to very low credit, or for different purposes. And so there's segmentation within this sort of asset class, if you want to call that. That further, I want to say complicated, but further, you need to understand, I guess, who you're lending to and what is the objective of the lender in private credit. Is that a fair way of looking at it?
Absolutely. I'd say even if you took the largest subsegment of private credit, which is direct lending,
Yeah.
that's where you're typically seeing senior secured, directly originated corporate loans, hence the term direct lending. That space in and of itself is the largest subsegment, but it's also segmented out itself into the type of strategy or the type of borrower that a non-bank lender is pursuing. You have a very vast middle market that we talked about earlier.
Yep.
Just so many companies considered middle market in size.
Yep.
Over 200,000 private businesses, which is enormous. But even within that span, you would typically segment the market by size of how big that company is. There's a lower middle market, kind of, in the single digit of cash flow or EBITDA, typically, the term in the industry. Then there's a core or more traditional segment of the middle market that could be more from like 10 to 100 million of EBITDA. And then an upper middle market with anything 100, 150 and higher. We've seen these segments actually shift around just a little bit as you think about private credit platforms growing and scaling and able to now service the needs of much larger borrowers that would have otherwise gone to the public syndicated market. So they're staying and choosing direct lending partners to execute their financing needs. So I do think that upper end of the middle market continues to grow, and then thus shifts the core traditional middle market upward a little bit as to what each of these lenders can now service. So there are very many different ways, different strategies, even within just the subsegment of direct lending itself, where you can think about how does this manager's typical borrower look, and what are the typical features of that borrower's needs that the lender meets? What customization, what flexibility, what covenants or lack thereof does a lender provide, because it meets a different size borrower every time? And are there common features into the core middle market and common features in the lower middle market and common features in the upper middle market that lenders are providing? Or are they stepping away from that? Are they doing something different? So I do think it's helpful to know what is the market And are lenders doing market-like terms, or are they doing something different?
So it can get pretty complicated. But let's talk about this ecosystem. Is this something that if tomorrow I rent an office space and hang a sign, proud member of the shadow banking system, private lender, non-bank lending, please come in, and somebody will just come in and say, hey, I want to borrow some money. Is that how I get? I know you're laughing because I purposely make it like silly, but but how do we get these quote unquote deals? I mean, actually, how do we get into that business? Because I assume people just don't show up at your office and say, no, I don't mean your office, one's office, and say, hey, I want to borrow some money. And say, oh, great, who do I write the check to? So can you talk a little bit about how this whole ecosystem works and how perhaps there are different components that we are dependent on each other to create this market and growing market?
Absolutely. It is a fully integrated ecosystem, I would say, and it is strongly driven by a partnership mentality. Because as you said, you don't just knock on the door and a deal shows up on the doorstep, on the welcome mat, in a perfect little package with a bow on top.
Right.
You have to find the opportunity, right? And in our terms we use in the industry, you're typically originating or sourcing that loan. And how does a lender even do that?
Yes.
Well, it certainly involves a lot of phone calls, a lot of meetings, a lot of relationship development to establish trust, to let everyone know how much capital you have, what kind of loans you make, what experience you have,
yeah.
And to also find out who are the partners that you'd want to work with that are actually pursuing investment opportunities that you would like to lend to. So, for example, one very common practice in direct lending is private equity-backed borrowers looking for financing, debt financing. That would mean a private equity firm, a manager, is making an investment in a company. They're going to buy a company. They want to buy it, and once owning it, they will improve its operations, professionalize its management team, expand where it operates, put in an ERP system that it didn't have before. But in doing so, it needs a couple of things. One, it needs capital to make the investment, and it'll typically use capital from its equity, its fund, but it would like to also debt finance that acquisition. So the private equity firm will look for a partner, a debt partner, private credit partner. And once you find that private credit partner, either it be one or a group, a small group of private credit providers, you want to make sure they have dry powder to help you grow the business as it has funding needs down the road. Because you don't want to have to call again around and say, hey, who wants to help me with the next debt financing need? We have an incremental need. Why don't we go back to our existing stable of relationship lenders and make sure they support the business for several years, because we all want to be aligned, which is grow the business, help the firm, private equity firm, sell it to somebody else, and we all get our money back. And the equity firm makes even more, right? So along the way, when you're going to look for private debt partners, that relationship development comes into play. If you've already been in the offices of a private equity firm, they know who you are as a private credit lender. They've potentially done deals with you in the past. They will more likely than not call you on the next opportunity where they have a deal. If you are out of sight, you're typically out of mind. Right? Mm-hmm. There, as you said earlier, a lot of options in the private credit space, and you want your voice, your name, your moniker to be the loudest, the one that they want to call. Now, beyond just being in their office all day long, every day, I think that's a different strategy. One I would not recommend. I think you could certainly advertise different things that help you stand out, right? You can have a bunch of people, a bunch of originators, boots on the ground, calling on everyone and blanketing the market, right? And that's a very expensive proposition. Or you can be lean and be very targeted on who you call, but you spend all of your time developing deep relationships with select few private equity firms, which is your source of continuous deal flow. Right? Because if you spend that 80-20 rule, 80% of your time on 20% of the private equity firms out there, you will potentially get higher quality, more quantity deal flow on the types of deals you actually want to do. So at Churchill, we pursue that latter strategy. leaner team, targeted focus, deep relationship development, where we advertise, if you will, our scale, our experience, our flexibility to propose multiple solutions to the borrower. And then that partnership mindset, where we're not just trying to be a commodity of capital to them. We want to help understand their investment thesis and grow with the business over time, show flexibility when we feel comfortable, but still put in the right guardrails. So in terms of origination and finding these deals, as you can imagine what I'm describing, it is difficult. It involves not only people, time, resources, relationship development. Some platforms like Churchill even have more advantages where we are an investor in the private equity firm's fund. It's an even more entrenched relationship. So we're not just calling to try to do a direct lending deal with the private equity firm. We're actually an investor in their fund and an important partner to that private equity firm as they continue growing. So getting phone calls either picked up by the private equity firm or phone calls proactively to our team at Churchill, I think that's an advantage where you get to see the deal first. And once you can see the deal first or in the first 3 or 4 phone calls, you can essentially try to take that deal off the table. Because if you're the 10th phone call or the 12th phone call, there are certainly other managers that have probably pitched a fantastic opportunity where the private equity firm doesn't have the time or the energy to keep calling around. They just want to move as quickly and efficiently as possible. And they want to work with a partner that can be there at the finish line and that can grow with the business. So I think capital scale is huge. Relationship development is huge. And having that entrenched kind of angle, if you will, where you're already an investor in the fund is a huge advantage. So it's a really unique process. It's one where you can employ different strategies, but in the private equity backed segment of this direct lending market, there are many ways that you can come about it, but it certainly requires a lot of thoughtfulness.
So it's interesting what you talk about private equity, how private equity sort of plays a lead role first. So let me think through this just a little bit. So to the extent that I understand private equity is where private equity managers identify certain companies to buy or to be sold to, or they will carve out certain parts of certain businesses that no longer fit that company's objective long run or whatever reason, right? So they say, great, we will take that off your hands for a certain price, or certain company wants to exit, owners want to exit, perhaps they don't want to go public, and so private equity would come in. There are all kinds of reasons why private equity get involved. And the private equity, in order for them to make the kind of commitment, they are actually sourcing investors to bring them the money so that they can then take that money to buy these companies or acquire portions of those. Then they said, well, gee, 100 cents on a dollar, I'm putting down 40 cents on a dollar. I need to borrow 60 cents, or I'm putting down 60 cents, I want to borrow 40 cents. And that is where they come to, if they are borrowing, they will come to folks like you who are in the private lending side or private credit side and say, hey, this is an attractive deal. Why don't you take a look? The relationship, all that you mentioned, then your firm or people in your space will review it and either say, yeah, I love to do this, or I put a pass, or what have you. But where you, from an asset management standpoint, are also out raising money from investors. So these are all different investors bringing their money together. One is from the equity side, and the other are from the debt side or credit side. And sometimes you are both, right? Sometimes maybe I have clients who are investing in this as well as that. So it seems like it's a big network of bringing private wealth into these private markets and then give the money to asset managers who are either private equity specialists and or private debt specialists and make all that marriage work. Am I thinking globally enough? Is that about right?
Yes, in that it is a complicated map that you may have just visually portrayed, but at the end of the day, the managers, the stewards of the capital, they're focused at the transaction level. And the transaction level, I mean to say, is the investment opportunity, right? That investment opportunity either exists as an equity, a private equity opportunity, or a private credit or debt opportunity.
Yeah.
Now, these managers have to raise their own capital to make these investment opportunities. So as an investor, you can find your way to a private equity manager, or you can find your way to a private credit manager.
Yeah.
And there are some that maybe you'd call it even more private capital, if you will, because they can do debt and equity.
Right.
But at the end of the day, these are incredible investment opportunities that are private, extraordinarily hard to source, very lucrative in that they are supporting healthy, growing businesses. But because the country is enormous and the world of middle market companies is enormous, and spending the time to find those investment opportunities takes expertise, people, relationships, you want to lean on a manager that can do that. So there's a lot of interest from the wealth side, individual investors who have never had this exposure before. This has largely been reserved to massive institutions that can commit serious dollars to that private equity manager or that private debt manager and feel comfortable locking up for a very long time and allowing those managers to pursue their investment strategies. In today's world, we've definitely evolved where there are different structures that the wealth community can finally see a little bit of exposure to this vast world of private capital investments.
So you mentioned earlier, there are refinancing needs and there are, different kind of needs that a private credit firm, asset manager can participate in as steward of capital. So what is an average life of a private debt, would you say? And is refinancing a risk to the lender or risk to the investor or what? Talk to a little bit about how that works.
So going back to that largest subsegment of private credit, direct lending, senior secured, directly originated corporate loans.
Yeah.
The average life, if you will, or let's start with the typical term of the loan.
Yeah.
It's typically 5, 6, or 7 years in its life to maturity. Mm-hmm. But in history and in practice, what we've seen is the borrower has historically refinanced or repaid that loan earlier than that term. Typically around 3 years has been that average. So it's pretty quick. It's in the realm of what I think would be the average sort of duration that you've seen in high yield if you were to compare it to a fixed rate type of debt instrument. Mm-hmm. So much shorter in terms of that term versus what is on the credit agreement. Now, what's important when you think about duration and think about fixed rate instruments here, senior secured corporate loans are in their nature floating rate instruments. So there isn't that risk of movement on rates and the impact to the value of that loan because it's going to float. As rates move up, it will go up and it will earn much higher yield. And as rates come down, it will float back down and earn less yield. But at the end of the day, what you go into the loan for is the exposure for that current income because you are receiving this sort of interest income from that loan. And over time, a very nice risk-adjusted return in that the loss rate associated with that loan is far lower than what you'd see in high yield, that you're essentially getting your return from that current income, right? Along the way, you come out at par, but along the way, you earned a really nice steady stream of, call it a distribution. So I'd say when you think about term, you want to think about it that way, 3 years or so on average. Refinancing or repayment as a risk to the borrower, though, or to the investor, I'd say it is something we watch very closely, the refinancing risk, if you will. But because there is so much deal flow in the market, if you have a great origination team and you can continue building your pipeline of opportunities, you will find a very, very readily available place to redeploy those repayments, even if we're in what we're seeing right now, a slower M&A environment today.
Yes.
But with very large scale platforms like Churchill and others who have an existing stable of investments we've already made, those borrowers are continuing to grow and they continue to have financing needs, even if the new buyout market is a little bit on pause or it has slowed down. So as repayments may happen, we can redeploy those funds into incremental financing needs of our existing portfolio credits. But I'd say in this market, it isn't a fantastic time to refinance. It is certainly more expensive, but to the extent repayments happen, there are readily available places to do that, even just looking at your own portfolio.
So before we go down this path, because you certainly think when interest rates go up and then when interest rates go down, they all have different impact towards the return. And of course, everybody want to lock in higher yield if I'm a lender. But if I'm a borrower, I want to not lock in for higher so I can refinance at a lower. But before we get there, you mentioned the term secure lending. Share with me, why do you think that middle market lending, as you understand and express, is a more secure and better way of protecting, as a steward of capital, better way of protecting the investors?
Sure. I'd say when we use the term senior secured, directly originated corporate loans, it's really important to remember that the term is in fact a bit more technical in nature, and that senior secured means more technically that the loan is secured by collateral that the borrower will, commit or post up in the credit agreement.
Right.
That collateral can take various forms. It is typically, anything that's readily available that's not already committed to someone else ahead of you. Typically, equipment can be committed ahead of you, but you can think about that capital at the end of the day most largely being cash flow that's generated by that business. So these are also referred to as cash flow-based loans, different from asset-based loans that will have that primary kind of security of the equipment. If anything goes wrong, they will take possession of the equipment and be able to sell it. So in senior secured direct lending, security here being cash flow generated by the business. But in terms of safety, I think every investment has risks.
Right.
It's more just about understanding those risks and where you stand in line of waterfall of repayment.
Right.
And how are you getting compensated for that risk? So for senior secured, directly originated corporate loans, you are typically at the top of or first in line of the waterfall of repayment should we need to go through a liquidation of the asset. That would be in more of the downside scenario, right? What could go wrong, which is what every credit investor typically thinks about. What can go wrong? But in terms of feeling more comfortable, I would say it's more of a matter of your view of how much risk you or your investor wants to take. Right? There are reasons, certainly, to feel comfortable taking a little more risk in going out to junior capital or to the equity, even though you're third or fourth in line of repayment, because you feel really confident about the prospects of the business, about who owns the business, who's running the business, the private equity firm who's had experience in that sector and has sold various businesses at 3 or 4 times their investment. That level of perceived risk can change depending on where you are in the capital structure.
Yep.
But for senior secured loans, technically speaking, you are first in line of repayment. So there is a perceived less risk, if you will, as compared to junior capital or equity co-investment from the line of repayment. But at the same time, you are getting paid differently. So you would typically have lower yield there than other parts of the capital structure that are junior to you. But at the same time, there could still be risk for everybody if the business is not a good business and it goes under, or it has too much debt than it can handle in a rising rate environment. And some of these scenarios are being much more scrutinized right now because we're in a place where we're at.
So when you talk about a cash flow revenue, I think of a government contractor, say, who has a contract with the government for a 3-year contract. It's X number of dollars, and they want to borrow some money off that. In other words, as long as they perform their services or whatever they're doing, government is going to pay. I'm using that just as for illustration only, not saying that's the way to go. So in the past, people have basically pledged that contract to a bank or to a lender and say, hey, this is $100 million. I need cash flow. I need to build, now that I've got the contract, I need to hire people, all that type of thing. Is it along that kind of line? I know I'm trying to simplify it. I don't mean that's the way you do it, but that's the idea, that we have a fairly certain stream of income or have demonstrated historically been very robust, and you have done the underwriting, you have kicked the tires, so to speak. You say, well, this is a very mature business, this is a whatever, and that income is fairly assured either by contract or by what have you, and then you lend against it. Am I thinking correctly in that sense?
Yes, that is essentially what you're lending against, which is the underwriting and understanding of how does that business make money, and how comfortable am I that its top line is highly visible, either because it's contractually, committed to see through the next 5 years, this client cannot go anywhere, whether it be by volume that they've committed to or by price. You have some sort of agreement with your top clients. That gives me a lot of assurance that there will be revenue generated by this borrower. And as long as they perform in a lean manner, they don't let their expenses go crazy, we will then see cash flow, profitability that will then be able to service my debt as the lender to this business. So that's exactly what it is when you talk about being assured that the business itself will generate cash, whether it be by contract, because they have contracts with the government, or because they've shown steady ability to maintain revenue or grow revenue with their client base or grow clients. Those are the ways that we're getting comfortable with lending to these borrowers that are considered middle market in size.
Interesting. See, I'm learning so much already. Let me try another question. One of the statement you made earlier, which is obviously true, anybody can see it, is when interest rates were very low, everybody's clamoring for higher yield. So they look to private lenders as one way to access a higher return on their savings, on their investments, which happened to give rise to private credit during those years. Today, of course, interest rate is significantly higher. We can go to get a treasury at 5.5% without any risk. So your baseline is much higher, and the expectation is higher. So a couple of things. I think one is, you mentioned floating rate, right? It means as interest rates go up, your borrower is going to pay more, and so there is a floor, and then you have additional interest rate that you charge. Great, that all makes sense. But as interest rate go up, then the total amount of interest rate payable, it goes up as well. And of course, there is a limit to that. Although I think the limit we're almost at that limit, but that's a sidebar comment. So when you think about underwriting, I guess you do stress testing and saying, well, gee, if I'm lending this at X%, but if interest rate go up by Y, does it have the room to do it? Can you talk a little bit about that and how private equity, because they also have skin in the game. They have big skin in the game if it's a private equity funded process or driven process. How do you play that, the two parties, you being the lender and they being the equity holder? Can you share a little bit about how that works?
Sure. So the interest rate environment we're in right now is absolutely key and fundamental to whenever we underwrite a new loan and determine what the right level of leverage is amount of debt it is to provide to this borrower.
Right.
So much so that we really want to understand, can this borrower satisfy debt service payments through the life of the loan, even in this much higher elevated environment that we're in. Not even today's, but even the terminal rate, where SOFR, the secured overnight financing rate, which is the base rate we use in senior secured loans, we'll get to. Maybe it's 5.4 today, and maybe it should be 5.5. We want to model that in and essentially, use that as the base case and take the forward curve of where it may end up staying if it's higher for longer and run the analysis to see, can this borrower service that debt? And what ends up happening is you thus, back into what is the right amount of leverage to put or debt to provide to this borrower so that they can comfortably meet that debt service payment. And I want them to do it with some cushion. I want them to do it so I'm not worried or freaking out that they can't make it every quarter.
Right.
That cushion we're ideally looking to see is 2 times. Please generate 2 times the amount of cash flow that we need you to service our debt. That's a considerable amount of cushion.
Yeah.
That means we're going to back into a much lower amount of debt than we're actually going to give this borrower. But if they want it, great. If they don't want it and they want more debt, then they may have to go somewhere else. But there is a limit, as you said, as to how much debt will be afforded to these borrowers. But that stress testing is both, it's twofold. You want to do the right base case in a reality environment, and then you want to have that stress case of what could go wrong,
right? Which
is why we guide ourselves to say 2 times cushion to start would be a very healthy starting point. Now, sometimes we go to 1.75, 1.65, 1.8, depending on how strongly we feel about the borrower.
Yeah.
But overall, having that 2 times cushion is that, can EBITDA, deteriorate by 35, 40% and still have a 1 times coverage of our debt service? All of these factors play in when we're determining what's the right amount of leverage or debt to put on this balance sheet. And then we'll propose that to the borrower. But in this environment, I'd say free cash flow is, absolutely the guiding, dictator, if you will, of how much leverage will be put on a business and the types of loans that we will make and the types of borrowers we will make them to. But as far as rates and the rate environment being a higher for longer potential scenario, I'd say with the floating rate nature we have with senior secured loans, our borrowers have been sort of legging up and dealing with higher rates as rates have been climbing, right? So we've been seeing that additional stress over the last 18 months, right, of our borrowers managing through higher interest. It's very different from a fixed rate instrument,
sure,
which has been thankfully and benefiting from a low place. And if they need to refinance, they're going to refinance into a new environment that will be potentially a little bit jarring, right? Where the floating rate loans have sort of been kind of going up quarter over quarter, and our borrowers have been having to be very lean, very efficient, be proactive about making sure they have the right amount of cash to service that debt. So I feel like we're seeing it real time in the private credit space, the health of our borrowers and their ability to withstand and handle these higher interest rates. Let's say it lasts a few more quarters. It may, but we're watching it real time and we can see that impact right away. To the extent that rates do come down, it'll be more relief for our borrowers. And at the same time, the yields in private credit will be impacted and they will come down. But that's where you have to think about private credit in the longer history of what has this asset class historically generated in terms of current yield. It's historically been an asset class in the 6, 7, 8% yielding range. That's a great yield. That's a really respectable place to be when your default and loss rates are also extraordinarily low. Because as we talked earlier, you're senior secured by the cash generated in the business, top of the capital structure, first in line of repayment. But to the extent we see, Fed's fund rate get cut, maybe 1-2 points over the next 2 years, where we're at today, this baseline you said, we are actually at yields for private credit in the 11-12% context because base rates have climbed by 400, 450, and spreads have widened out by another 100, 150. and the original issue discounts kind of widened out by another 100. So you add that 6% of yield to what historically was 6 to 8%, you're now at 12% yields for private credit. If that was impacted by the floating rate nature and it went down by 2 points, you're now at 10. 10 is still pretty phenomenal for senior secured loans. I'd say it's not even back where we were for the past decade plus.
Yeah.
So I do think it may be impacted, but at the same time, you're also going to see and experience that extremely low loss history and lower default rate history in this asset class relative to others.
And I think the candle can potentially burn on both ends, right? So if the Fed doesn't stop raising rate, which is not the base case for just about anybody, that we are at the probably much closer to the end rather than still have a lot more to go. So we have seen the high or the very end of the hiking cycle. It may stay higher for longer, not may. That's what Chair Powell has been broadcasting for 2 years, and we're going to keep at it until we get the job done. But the other end is that a high interest rate, the whole idea is to slow down the economy.
Right.
The whole idea is to lower the consumption or economic activity, however you want to call it, in such a way to bring demand down, because at the end of the day, inflation is substantially caused by demand. There's not a lot we can do about the supply side, but behavior is on the demand side. So you can actually have a business that would have done well if the demand continued a certain pace, even at a higher interest rate.
Yes.
So when you do underwriting, do you think about, not only you, but I assume your industry would think about not only the cost of borrowing, the cost of capital is rising, but the other side where the income coming in perhaps is curtailed because of a slowing economy. How do you think about that to protect investors' capital?
Certainly. I think it really comes down to a few things. Number one, the selectivity that you maintain, the discipline you maintain on the companies for whom you lend to, right? So if you are in the believer that you are a buy and hold investor, that means you need to be ready for that 5, 6, 7 year term. Maybe historically, as I said earlier, you might refi in 3, but that's not a promise. But you need to be prepared that you're going to be in this loan for potentially 7 years.
Yeah.
And as we look back at cycles, things can move within 7 years. The economy can dramatically change within a 7-10 year period of time. So you need to be prepared for recession. And what we do is we stress test every loan we make as if a recession will happen. And then we look back and see if that happens in a recession scenario, what are we comfortable with the cushion that we want to see in this business? So underwriting for us and underwriting to a downside that includes a full-on recession is a part of every case that we do. So as far as thinking about the private credit asset class, that's number one, underwriting to a recession case. Number two, I'd say around selectivity as well. You want to see managers, private credit managers, really pick and choose those defensive, less cyclical sectors to start with, right? It could be a great business today, but it got here because there was a lot of consumer discretionary interest, trend interest, really promoting post-COVID excitement. If it's home food delivery, if it's, some latest, greatest fad, how sustainable is that? How sustainable will that be for the next 7 years if you're going to be in this loan for 7 years? So really focusing on sustainable, defensive, less GDP sensitive kind of sectors is another way that you can really avoid the pitfalls of what could be slower economic growth. At the same time, the tension of higher interest will be, affecting your borrower. So at the outset, you want to pick the right companies. And then third, I would say with private credit, interestingly, there are far less cyclical companies, loaned to in the private credit universe than what you'd see in the public credit market, which is a very big market. And even in public, equities, if you were to look at the categories of, cyclical versus non-cyclical,
yeah.
I'd say statistics have shown that the private credit universe has maybe a third or less considered in that category. Whereas it's turned around in the public market, the public credit markets, it's almost 2/3 have that kind of cyclical element or some cyclical elements to it or cyclical end markets. So I do think as an asset class, private credit lenders have really been trained and honed in on the fact that we are buy and hold investors.
Yeah.
We need to invest through the cycle. And in doing so, that includes economic, slowdown.
Yeah.
But I think we had the best experiment ever with COVID. It wasn't a slowdown, it was a complete stop.
Yeah.
And no one could have foreseen that black swan event.
Yeah.
And that just happened about 3 years ago, right? It feels like ages ago.
Yeah.
I mean, 3 years ago, we never thought we would leave our houses again or wear shoes, but here we are. But
certainly no more ties. No more ties, that's for sure.
No more ties. But maybe some have come back with a vengeance, so they want to come back. But I'd say that experiment really put into focus, wow, that's beyond a slowdown. What do I need to do to survive?
Right.
I don't want to be in a cash burn situation. I need to let go of people. I need to move to a technology system. I need to really get lean. That's what these companies were thinking. Fast forward to today, I would argue that you have stronger, more resilient companies that have withstood what the pandemic brought to us and maybe have either benefited on new trends and new categories of consumer needs that have happened off of that time in our life that are probably better suited to handle a slowdown.
Yeah.
If it's a fraction of what we saw during COVID. Now, COVID didn't last for forever, but it certainly caused that stop. And we all had to think more clearly and do more with less.
Yeah.
So I would say you're probably looking at overall higher quality, more resilient companies with lenders and lending partners that know what to look out for and put the right, more responsible amounts of leverage and debt on these businesses than what we've seen in decades past. Because what I really hope for our industry is that we are all operating on that lessons learned approach. Like, let's please not commit the mistakes from before, and let's support great businesses, demand more from these borrowers, and make sure that they're healthy and operating in the right way.
This area requires really the kind of manager that you need or one needs as an investor to align the expectation of return and the expectation of risk properly so that the investor's expectation can be met. So let's put it another way. If I want to go to the junior credit, if I want to do some other things, so I want to take on more risks for a potential higher return, I should not confuse just looking at higher return and say all managers are the same, because their processes are indeed different. Their market segment that they go after is different. Their relationships are different. Their judgments are different. Their risk tolerance different, right? They're testing the future scenarios may be different. So I think it seems to me that having significant due diligence of the private market manager, not one person, but the operation is probably job one. Because
Absolutely.
we cannot tell the future. Nobody can tell the future. And looking at the past alone to judge future is probably also an issue. So it's really about what is the process by which the manager employs is probably the safest thing to analyze as we select this type of investment. Is that a fair question or statement?
Yes. I feel like in today's world, you cannot just assess managers on track record alone.
Yeah.
Or the returns that they're promising or targeting.
Yeah.
Or even pointing to, because these numbers were in a very elevated environment altogether, 11, 12% yields on senior secured loans. It's very exciting.
Yeah.
But that 11, 12%, I feel very strongly that each manager got to those yields in a very different way.
Yeah.
And understanding the process in which they got there is job number one.
Yes.
And your feeling and confidence that that is a sustainable process is job number two. That is really taking insights, but you have to ask the right questions.
Yes.
You have to meet more of the team, right? One person telling you the story of how the firm was built, it's that storyteller's view of the firm. But if you can confirm that with potentially a few more individuals, or that at least the story is resonating and reinforced based upon the types of deals done, and even more so, the types of deals or investment opportunities that the manager has turned down.
Yes.
I think it's going to be eye-opening to see in this environment the types of deals that managers back away from, that lean back. What is a deal that you would not do? And I think that's very important. In this environment, I'm assuming everyone's still very selective, given it's tough out there. But even more so, in a great environment, when M&A activity is high, everyone's happy, the economy's back on its feet, what are the deals you're turning down in that environment? That will be very telling. But these are questions that you need to probe into and ask, because it's the process, right? But your numbers may look very similar to someone else's numbers. The loss rates in the private credit and direct lending asset class are very low, less than 1%. Everyone's going to tell you that. But how did we all get there? Right? Did you start in one segment of the middle market and you drifted up to the upper middle market? That's great. Why did you do that? Do you have advantages in the middle market that you didn't have in the core middle market? What prompted that? And are you going to continue having those advantages, or are they temporary for right now, given the broadly syndicated market being shut? I think that just understanding process, evolution, sticking to your knitting or not, and ramifications of that will be really important when it comes to manager selection and that criteria.
We cover a lot of ground, and but on some level we're just scratching the surface, because I feel that there's a lot more you're going to tell me. But thank you for sharing your knowledge, your insight, and your experience with me, and I definitely feel smarter as a result of it, and much more understanding of the ecosystem, and that if we are to invest in this space, what are some of the things that we should be mindful of, and what kind of due diligence process that every investor should undertake.
Absolutely.
We may have to do another one of these things to burden you to share more of your thoughts in the future, and to dive into deeper, like foreign markets. The U.S. is the most developed private market. Are we thinking about Europe? Are we thinking about Asia? And it's about data, and it's about all that. I think will be fascinating to think about as well. But until then, I just want to thank you.
Absolutely. I enjoyed it so much, Philip, and I look forward to a part 2 if I get the honor of doing that.
Of course. But thank you very much. Really, thank you for your time.
Thanks, Philip.
You can always find more episodes by visiting philipchao.us/podcast, or find us on your favorite podcast app. You can always leave us feedback, ask questions, or request a topic for us to discuss by sending an email to pc@philipchao.us.
Views expressed in the Tao of Chao podcast are individual opinions, and they do not represent the employers of each guest or the firm each guest is associated. Our podcasts are for educational and informational purposes only and should not be deemed or viewed as investment advice or recommendations. Please consult your personal financial advisor, investment expert, or investment fiduciary before taking any actions about your plan and investments.